Today we are breaking down the lower of cost or net realizable value rule. Like many things in accounting, it sounds more complicated than it is. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. One of my favorite times back in my retail management days was the day after candy holidays. You know the candy holidays, right? Easter, Halloween, Christmas. It's those holidays that have seasonally themed candy that's obsolete the day after the holiday. Why is it my favorite? Candy markdowns. Cheap candy, my friends. And with each passing week, it got cheaper. Well, all these years later, I no longer work in retail. And other than a very occasional red fish, I rarely eat candy. But I have the memories, and the accounting lessons will linger forever. So how do candy markdowns relate to lower of cost or net realizable value? Well, let's talk about what net realizable value is. Let's say we own a store and we purchase some holiday candy, and we pay $1 for each piece of that candy, and we sell it to our customers for $2. The day before the holiday, the net realizable value for that candy is $2. That's what we can sell it for. The day after the holiday, we take a 25% markdown. Now our net realizable value is $1.75. We're still making money because we only paid $1 for it, but not as much money. A week goes by, and now we mark our candy down to 50% off. Our net realizable value is $1. What we bought it for and what we can sell it for are equal. Another week goes by and we mark our candy down to 75% off. Now our net realizable value, what we can sell it for, is 50 cents. Our cost is $1. The lower of cost or net realizable value rule, which is part of our generally accepted accounting principles, our GAAP, says that we will use either the cost of the merchandise or the net realizable value, what we can sell it for, but we have to use whichever one is lower. That's part of the conservatism principle of GAAP. So here in our handy chart, we see the time. Is it the day before the holiday, the day after the holiday, or 2 weeks after the holiday? We can see our cost, which is always $1, and we can see how our net realizable value changes based on how far we are beyond the holiday. So our net realizable value the day before is $2. That's what we can sell it for. The day after, it's $1.75. Well, for those 2 periods of time, our cost is less than our net realizable value, so the lower of cost or NRV is going to be cost. It is $1 for cost, $2 or $1.75 for net realizable value. The lower amount is our cost. Now, a week after the holiday, our cost and our net realizable value are the same. It doesn't matter whether we use cost or net realizable value, they are the same number. Well, 2 weeks after the holiday, our cost is still $1, but our net realizable value is 50 cents. So the lower of cost or net realizable value would be net realizable value. So that is the amount that we would use. Now, let's say, rather than talking about candy inventory in a store, let's talk about the company that produces the candy. And let's say candy sales were down this year, and we produced far more than we were able to sell. Now we have a warehouse full of weird yellow marshmallow blobs, and it's the day after Easter. Our inventory value has dropped. It's no longer worth what it was the day before the holiday. So we need to make a determination as to whether our cost, what it cost for us to produce and package the blobs, is still lower than our net realizable value. We don't want to take an inventory write-down if we don't have to, because an inventory write-down means moving costs out of inventory and into an expense account, doing something like a debit to cost of goods sold and a credit to our inventory account. Because when we do this, When expenses go up, our profits go down. So we want to do everything that we can to move that inventory quickly to get as much value for it as we can. But the lower of cost or net realizable value rule is there to cover the inevitable loss of value for unsold goods or obsolete products. Until next time, stay balanced, my friends.